Hello, friends. On behalf of the Women and Young Members Excellence Committee of ICI, I, Ishita Visaria, extend warm welcome to all of you to the Sky Symposium series. It is a platform created by the committee to share technical updates, enhance non-technical skills, and encourage our members to confidently express themselves in public forums. This initiative aims to empower and inspire our members to step forward and make the most of their abilities. The chairperson of the WIMEC is our very own CA Preeti Savlaji, who is also chairperson of Sustainability Reporting Standard Boards and vice chairperson of Valuation Standard Boards for the year 2023-24. Vice chairperson of WYMEC is CA Abhay Chacharji, who is also chairman of Commercial Laws, Economic Advisory and NPO Cooperative and Vice Chairman of Accounting Standard Boards. This Wednesday, program has been thoughtfully designed to nurture the growth and development of our cherished women and young members. Sky High Symposium is not just about technical updates. It is a platform to cultivate non-technical skills and empower members to shine confidently on the public stage. Today's session holds the promise of enlightenment as we explore the realm of FEMA and professional opportunities. Our today's speaker earlier was Ms. Tanvi Vora, but due to her ill health, she will not be able to join us. However, the session will be led by her colleague, CA Hardik Deepak Mehta, and we welcome him to grace us his insights. The speaker introduction. CA Hardik Deepak Mehta is a proprietor of Hardik D. Mehta and Company Chartered Accountants. He is a fellow member of the Institute of Chartered Accountants of India, professional experience. He has over 14 years of work experience and specializes in advising clients on exchange control law and regulations, FEMA, transfer pricing regulations, and international tax law. He also regularly represents clients before RBI and income tax authorities. He has appeared before Commissioner of Income Tax and Dispute Resolution Panel in cases involving issues related to international taxation, transfer pricing, and other income tax matters. He also advises and assists Indian NRIs and subsidiaries of Indian companies in USA in filing their US tax returns. He was previously associated with MB Naik and Company Chartered Accountants for nearly a decade and retired as a partner in December 2019. He did his Bachelor's of Commerce BCom from Narsi Monji College of Commerce and Economics. He qualified as a chartered accountant in June 2009. He has also cleared all papers of Certified Public Accountant US CPA examination in 2018. He has also completed his Advanced Diploma of International Taxation ADIT. Over to you, Hardik.
Thanks, Ishita-ji. Thanks, the women's team, Jaya-ji, and all the committee members, and also Chairperson Preeti Savla for giving me this opportunity. So my colleague Tanvi was to take this session. Unfortunately, I have to step in her place. So basically, it's a replacement, but I hope I do the justice to the subject, and we can just start it. Before I start, I would just like to request all the participants that let's make it as interactive as possible. If you have any questions or any queries, we can always have it at the end, but you can always drop that in the Q&A box, or we can unmute you, and we can take up that as and when you need that. So just a sec. Is my screen visible? Can someone confirm? Okay, great. So today's topic is FEMA and professional opportunities in today's time. The whole point is there are so many opportunities all around the profession. FEMA, in terms of that, might look to be a very small area of practice for people who have never indulged into or been into FEMA practice. However, let me tell you, I've been in practice for last 14 years, and I have spent good amount of my practice time in FEMA and its law and compliance. And there has been enough opportunities of late with India opening up its I would say economy almost 30 years back. In fact, today only I received a message that around 20 years back, our FDI was $2 billion, and this year we have touched some $71 billion. So the kind of foreign exchange transactions which are taking place in today's date, the numbers are mind-boggling, and India is kind of a magnet to the world where people would like to invest. Likewise, we are also a developing country, and a lot many Indian MNCs who are going outside India, either forming branch, subsidiary, joint ventures, and doing business outside India. In that sense, it's both ways. And Since we are not as open on foreign exchange as developed countries are like US, or for that matter even Singapore, or any other countries, we have a very exhaustive foreign exchange law. To give you a little brief, it was earlier known as FERA regime. From 2000, it has been, it was superseded. The FERA Act was superseded, which was Foreign Exchange Regulation Act. Now it is Foreign Exchange Management Act. So in that sense, the government is clearly on the path of saying that we would like to liberalize, we would like to now manage rather than regulate the foreign exchange transactions. However, there are a lot of rules and regulations which one need to follow on different type of transactions have been undertaken by the entities or individuals, like say, uh, and we are going to discuss some bit of that. What I'm going to do is I'm going to take a case study. There are more than one case study, but my focus would be to cover just one case study, which normally I take, and that is so exhaustive that you come to know that what are the opportunities, or where can a professional practice as a FEMA and be as a compliance help, or be as a value addition as an advisor to companies, both in terms of inbound and outbound investments. I think that case study should cover all the nitty-gritties which can be available to a professional while practicing in FEMA. Now, first, what are FEMA rules and regulations? If someone who is little bit well versed must be knowing that FEMA as an act is a very concise, is in a very concise form. There are only 49 sections. Uh, so per se, people would feel okay, 49 sections is nothing. It's such a small act. But does FEMA get only regulated through a 49 section act? No, there are different rules and regulations. In addition to that, there are master directions. So I've just listed down what kind of the rules and regulations one should be aware of, and this is, I think, where one should be of mindful. There are something called current account and capital account transactions. We'll discuss this in detail. Definitions first. There are different definitions. A very basic thing. Let me tell you, how the person resident in India definition under Income Tax Act and FEMA is so different that there can be a situation where a person is a resident under income tax but is a non-resident under FEMA. Likewise, he might be a non-resident under income tax but a resident under FEMA. So it depends, because both definitions are different. FEMA definition is per se intent based, over and above the numbers of days, and in that sense, that's the difference between the two definitions. So that's why definitions play an important role as far as current and capital account transactions are concerned. Current account transaction rules is something one should look upon while doing any kind of import, export of goods and services. Even capital account transaction regulations needs to be studied. There are different schedules which says the amount, the type of transactions which are prohibited, which are regulated, and which are permissible. There is a cardinal rule under FEMA. All current account transactions are permissible unless prohibited. All capital account transactions are prohibited unless permissible. So they both are vice versa, opposite to each other, because capital account transactions, which is mainly FDI, foreign direct investments, ODI, overseas direct investments, ECB, external commercial borrowings, which takes into account loans in rupees and foreign exchange. They all are regulated in that sense. And imports and exports are something which are largely liberalized, except the documentation part and certain regulations concerning the write-offs and for discounts and everything. So yeah, so this is one thing. Then, of course, FDI, most popular, I would say, almost in my whole practice, and even for that matter, if you see, there is a good amount of practice which revolves around FDI advisory and compliance. When a foreign company, a foreign entity wants to do business in India, they would invest in an Indian company, they would form an Indian company, or they would form a joint venture with an Indian company. Uh, and that's where the FDI regulations kicks in. What are the things one needs to be kept in mind? One should refer to non-debt instrument rules, instrument regulations, the mode of payment and reporting of non-debt instrument rules and regulations, consolidated FDI policy, master directions, and FAQs. FAQs, I will say, might be if one go from a legal point of view, FAQ should not have any value in that sense, but it has a lot of persuasive value. uh, RBI do is a regulator after the change in 2015 in the Act. The law is been now legislated and amended by the central government. RBI is the authority who implements the same. And in for that sense, one needs to be very much aware that what RBI thinks. Many times it might so happen that you feel okay, this is neither prohibited nor permissible, so we should take a for that we can take a positive you know a positive view that since it is not prohibited, so it should be permissible. But that sometimes FAQs gives a good amount of insight of what RBI thinks of such transactions. And if RBI has a view which is not coming out of the regulations but from an FAQ, it would be great. It would be a good thing for the clients and practitioners to follow that view. In case you need clarification, you should always go back to RBI. They are more than happy to clarify on any of the transactions, unless you go for specific opinion, which they would not encourage for that matter. Another thing is foreign and lending in rupees and foreign exchange. This is per se a very important area, because I have seen over the years people have very many misconceptions about loan transactions. I had an occasion of speaking on FEMA multiple times, and even in whether in person or virtual, people have asked me many times that when there is FDI which is permissible on non-repatriation basis without any conditions, why loans are not permissible? One is to understand when you talk about equity or when you talk about investments in equity instruments under FDI regulations, there are two type of two routes which are available. One is non-repatriation, which is repatriation for NRIs, and that's why most of the NRIs, if they want to keep money in India, they would always go by non-repatriation basis. However, if they want to repatriate the money in outside India, they would invest on repatriation basis. So I have seen practitioners and clients being confused whether that same analogy should be applied to borrowing and lending. I would say no. There's nothing like non-repatriation basis or repatriation basis in terms when you borrow from outside India. In fact, we have a very extensive rules and regulations which govern borrowing and lending. One needs to be very much aware about it. Then comes the overseas direct investments. Overseas direct investments and outward remittances by resident individuals. Uh, of late, very recent as last year in August 22, there has been a complete overhaul of these regulations. And let me tell you, there is a lot of liberalization and lot of clarification on the transactions as far as overseas investments are concerned. Even overseas investment doesn't only apply to companies or LLPs, or for that matter, any entities investing outside India. It also applies to individuals. I understand people who must be aware of a little bit of foreign exchange transactions would confuse this with LRS, but let me tell you, don't confuse it. They both go hand in hand. LRS is a liberalized remittance scheme where you are allowed to remit for certain type of transactions, which includes the remittance even for capital account transactions. For that matter, the limit of $250,000 is inclusive of everything. However, the compliance and the rules and regulations one needs to be followed while investing under LRS would be from overseas investment rules and regulations. There is this, they both run parallel to each other, and one needs to be aware of both the regulations. There are a lot of caveats as far as individuals investing outside India, what they can do, what they cannot do. So that's why these are the rules, regulations, master direction, and FAQs one needs to be aware of. As far as import and export of goods and services are concerned, let me be very clear. This is something which impacts most of the traders in India who is importing or exporting, or for that matter, even service industry. India is one of the biggest offshore markets for the Western countries, and we do have a lot of our I would say foreign exchange earnings from outside India in terms of exports of goods and services, and that's why these regulations also has a special importance in practice. Overall, if you ask me, where can a professional can be part of this whole practice, we as a professional, as a charter accountant, uh, it's an end-to-end service. Let me tell you, when there is a company who is coming to India, they would need entry guidance. They would need advisory on how to invest in India. At the same time, doing their investment in India, they would be doing substantial transactions, whether they would be getting dividend from their shares, or they would be investing in terms of lending to Indian company. They might also do some kind of a transactions in terms of import and export, and at the end there would be an exit which will be needed by them, whether they transfer that to other Indian investors or to another foreign investors. Everywhere foreign exchange plays a major role. Likewise, exactly the reverse, when Indian companies investing outside India, to set up, you do the remittance under ODI, you do annual filings, you also have the remittances coming in from that company, and at the time of disinvestment of that company. So I think per se, if you ask me, FEMA is a regulatory perspective which one should always be aware of. Apart from tax, I have seen many professionals who are excellent in terms of their taxation, as a field, as knowledge, as a subject matter expert. But if you have a little bit of working knowledge of FEMA, it can be very helpful. Many times plannings, or for that matter advisory we give, or structuring which we do, might be very doable or fancy, or for that matter kind of appealing for client. But if it's regular, as far as regulatory perspective is not doable, if there is a bottleneck in terms of FEMA, whether it is allowed or prohibited or with a prior approval, then it becomes a hindrance to carry on that structuring or restructure that transaction. What I have done is, and this is which you will hear from many FEMA experts, FEMA from auditors' perspective. Why FEMA from auditors' perspective? Most of the participants must be definitely doing some or the other kind of audit practice. Uh, Whenever you do an audit, do you need the knowledge of FEMA? you must be aware of the accounting standards. You must be aware of even income tax. You must be aware of certain allied laws which plays a huge importance. So like for that is for matter provident fund, gratuity. But whether do you need a knowledge about FEMA? Do you need to look the financials or prepare or review the financials prepared by the companies from FEMA perspective? Is it the need of the hour? I would say yes, because one of the very important sections which refers to the director's responsibility statement says that the directors have devised proper systems to ensure compliance with the provisions of all applicable laws, and such systems were educated and operating effectively. As a statutory auditor, you need to comment on this. If the company is under the criteria of where IFC is applicable, you have to comment on this in your independent auditor's report. It doesn't give you any leeway as far as the laws are concerned. It includes all laws for that matter. FEMA is just one of the law which you should be aware of. Apart from that, what happens if if the company doesn't follow FEMA? What happens if there is a contravention by the company? Uh, 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 does that only impact the company, or it also impacts the management who is kind of at the helm of the affairs of the company? I would say if you read section 42 of FEMA, it clearly says that apart from the company, even the person who was at the helm of the and was responsible for the conduct of the company would be guilty of the contravention if he is unable to prove that the contravention has happened without his knowledge or her knowledge, and he has exercised enough due diligence to prevent such contravention. If this is not proved, then by default, Section 42 would say that the director or the manager or the managing director or the secretary, for that matter, would also be compounded for the contravention which is being undertaken by so-called company. So this is very very important for charter accountants to be aware of. So not only the companies, even the management are nowadays very much. In fact, a lot of awareness have also been created by the government, where the cases under FEMA has been investigated by Enforcement Directorate, and wherever there is news reportings of ED, and for that matter, I have seen many board members or many owners of the companies who always speak to me and say that we don't want any ED coming at our place. Please make sure that FEMA has been complied with. We are very much in that sense. I won't say afraid, but we want to be very careful as far as our foreign exchange dealings are concerned. Can someone confirm whether the Q&A is something which we can receive at the time of the lecture, talk going on, or it has to be only at the end? So you have a Q&A box, I understand. Q&A at the end. Okay. But do the participants have to post in the box, or you will be unmuting them on the box? Okay, okay. So yeah, so of course we can take it at the end. But if there is any, let me know. So I would be more than happy to take it while having the lecture. So that makes a lot of things clear, and it is proper interactive one rather than a clear cut monologue. Yeah, so this is what I think we have already discussed, and I'm not going to, uh, you know, uh, go through that again. But what is so what we are going to do is now, uh, as a professional, if I am being given a balance sheet of a company, how would I look each item from FEMA's perspective? Okay, so let's assume there is this let's take this certain transactions or certain items liabilities where it says that shareholders funds is the first line item which you normally see. So when you see shareholders fund, as an auditor, it should click you that you need to ask whether there are any shareholding pattern includes any of the foreign residents,
foreign citizens, foreign companies, foreign entities? If yes, whether the FDI rules and regulations, compliance under FDI has been complied with, whether there are any convertible instruments which are issued, whether the guidelines in terms of pricing those convertible instruments have been complied with under FEMA, from FEMA perspective. If you look at non-current liabilities, which is mostly the long-term loans, secured, unsecured loans, one would be, should be asking this question to the company: has there been any loans and advances which has been obtained from non-resident shareholders, directors, companies, or for that matter, group companies? What are the terms of that loan? Whether the ECB, there is a loan registration number which has been obtained under FEMA when you receive any loan and you comply with the compliance of filing form ECB with RBI, that is through bank. I will always use this AD bank or bank because AD RBI doesn't deal directly with the companies or with the individuals. They have to always route their transactions or their queries or that applications through the AD banks, to the banks like your normal banks, your PSU banks, SBI, HDFC, ICICI, Bank of Baroda, any bank which is a bank which is allowed to and enter into or comply with foreign exchange transactions. There might be some cooperative banks which have tie-ups with such large banks because they don't have any team of MR desk in the in-house, and those transactions are not routed through them. So they are very small banks. However, the most of the large, mid, and the renowned banks do undertake FEMA transactions and compliance. When you say the current liabilities, short-term loans, trade payables, you would always ask whether there are any short-term loans from 6 months to 3 years, whether there are any payables which are outstanding in terms of imports, whether you have been, regularly paying those under the time limit of what has been mandated by the rules and regulations. When you look at assets, let me tell you, as I told you, I was discussing about current account transaction and capital account transaction. Capital account transaction doesn't per se say that capital account as per accounts. Accounts would say capital account means fixed assets and everything. No, even under FEMA, a fixed asset purchase equals current account transaction. When you say capital account, you have to put balance of payments in mind, how India's balance of payments work. Anything which goes in the balance of payment liability of assets, that becomes capital account transaction as far as FEMA is concerned. So, but however, if you acquire any immovable property, you need to take, outside India, you need to look upon the OI rules and current account transactions. Any investments outside India, you need to look, as I told you, the new overseas rules and transactions and regulations. Loans and advances are also being covered. So when I say ECB only covers in borrowings and lending in India. It does cover, however, it refers to the overseas investment rules because as per the current framework, you cannot give a loan to a overseas entity unless you have invested or you control more than 10% of the overseas entity. Otherwise, as an individual or entity, you cannot give loan or guarantee to that overseas. When you look at now, this was the balance sheet. Now, so that was the fixed assets, then the loans and advances. Now we go to the current assets, trade receivables, which largely takes into account your export proceeds, apart from the domestic payable, domestic receivables, cash and bank. You can also open a branch outside India. For that, you have to open a bank account outside India, and there are different regulations which govern that. Guarantees, whether you have any guarantees given outside India, whether there is a contingent liability for the same. In fact, there is a very common question which I always ask. There is something called compounding under FAMA. If you are not aware of, let me tell you, compounding is as a process where if there is any contravention which is taken place, you can go to RBI and compound those contraventions by paying a fee towards the same. If as an auditor you come to know that there is a compounding procedure which is going on, or there is a contravention for which a compounding is needed, whether would you include that as a contingent liability in your financials? That is a question which a auditor needs to ask. And if I am of the view that becomes a contingent liability and should be taken care of, and should be reported for that matter in the financials or the notes. Just a sec. Uh, Profit and loss from auditor's perspective: sales, as I told you, exports, any other income which you receive on interest from overseas, for that matter, even royalties, or any other income, whether it's a dividend income, either they would be current account transaction. Mostly, of course, all incomes would be current account transaction, unless there is a other income where you disinvest and you have gains or loss on that disinvestment. Expenses, have you written off any debtors? Have you paid any interest to the foreign entities, or like on ECB? Has been there been any remittances over and about that? So you would always look upon to this thing. Yeah. So before we move on to case study, uh, 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 as I told you, I would like to have this interaction. Can Ishita or Malvika, can you let me know whether there are any questions which I can take up right away? Okay. So I don't think so. There are any questions per se. I don't know whether I can see them because there is a chat box, but there is no Q&A box. So okay, anyways, I will leave to you guys. So let's jump to the case study right away. And the case study currently, which we are going to, per se, look upon would be a case study by an Indian MNC, impact under FEMA. As I told you, this one case study would be taking care of almost. And let me tell you, this is a real life case study. I was fortunate to have one of these clients where I had to dig up and look upon almost every type of transactions where there was a FEMA impact, and of course it was a great experience, and that's why I've made it in the form of a case study, so we can discuss that. And this is where I think you will come to know that as a professional, what are the opportunities which you can have in your when you are dealing with your clients, and what type of transactions the knowledge of FEMA or practicing in FEMA can help. It can really open up a different avenue, a different stream of practice if you are not into it already. And we can just you will come to know about once I discuss every transaction. So this is a private limited, and let me tell you, there is exports, there are imports, both are impacted by FEMA rules and regulations. There are bad debts written off. You have to ask whether they were domestic receivables or they were export receivables. There is interest on loan, whether that loan was obtained from outside India. There is a loss on Australia business. So that seems to be a foreign investment outside India, overseas investment outside India. We'll see that from the facts. There is a royalty payment on the income side. There is also interest which has been received. There's a interest in dividend which has been received, and also there is a creditors which are written off. So whether import creditors have been written off or not, one needs to check that. As I told you, this is normal balance sheet. A Private Limited has equity. We need to check whether there are any foreign shareholders. There is a loan from Bank of Tokyo. So there's definitely a ECB. The import creditors, there is a investment in SPT Limited. If you are aware, PT Limited normally stands for companies incorporated in Singapore. There is a short-term loan which has been given to SPT Limited. There is export debtors. There is a UAE branch. So okay, they also have a business in a different region outside India, UAE, in terms of through a branch. Okay, so this is a history of a client which has been informed by accountant Mr. Y. It says that Indian the company A Private Limited is engaged into FMCG sector, which was set up in 1992. It had its first FDI from a foreign company, B Limited, in 1995. The investment was to the tune of 20% of the share capital. A Private Limited further issued. So right now, as what we understand is, A Private Limited is a company which already had a foreign investment in FARA regime. As I told you, FAMA was implemented in year 2000. However, the Foreign Exchange Regulation Act was there before that. And since the company was incorporated in 90s, they also had the FDI from a foreign company, B Limited, in 1995. So the next question would someone ask is whether the if approval was obtained, because in those days you could not invest in India apart from a prior approval from RBI or government for that. A Private Limited then issued shares to B Limited and other resident shareholders through right issue, 1 is to 1 in 2004. So again, there was an FDI, though through a right issue. However, there is a twist. B Limited, which is a foreign company, was liquidated and all the assets, including Indian company shares, were transferred in the name of Mr. X, a US national who became the 100% shareholder. In 2012, A Private Limited set up a SPT Limited with SGD 10,000 as investment in Singapore. So I hope the second point is clear. So the private limited, the foreign company was liquidated, and then the ownership was transferred to a foreign person who was a US national. Then we look in 2012, now it is outbound. The A Limited also set up a Singapore company, which we saw in the balance sheet. If you see here, there is a SPT Limited, investment with SGD 10,000, and a Singapore Private Limited, Singapore PT Limited was engaged in buying and selling of FMCG products. In 2015, SPT Limited obtained a working capital loan of USD 3 million from Citibank Singapore, where it had asked for a corporate guarantee from of $3 million from parent company. So there is a back-to-back guarantee, which is very obvious when there is a loss of an Indian company and it is not self-sufficient. They would definitely ask for the holding company to give guarantee to the tune of the facility obtained by it. Mr. X, a foreign national, was also appointed as a director in 2016. In 2017, A Private Limited also set up, we saw UAE branch in UAE. In December 19, there was 1 is to 1 bonus shares which were issued. So it must have also been given to Mr. X. In January 2022, A set up another subsidiary in Australia. Remember, we saw here there was a loss on Australia business, and we now are informed that in January 22 only this subsidiary was set up. We need to see when it was closed. So yeah, so these are the transactions which were reported by CFO Mr. Z for 22-23, because we are auditing 22-23. So we are asked, we are told about the current year transactions, and they have been told that there is a short-term loan which was obtained from Mr. X, a foreign national, in April 22 of 1 CR and returned in September 22 with 9%. Whether this is doable, we will check that. But this is where ECB rules and regulations kick in. In October 22, company obtained an ECB working capital loan of USD 1 million. Remember Bank of Tokyo, there was a loan which was there on the liability side, and the processing fees was 1% and the interest rate was 2.5%. Australian subsidiary was closed in December 22 due to poor market response. So it's not even lasting a year. Mr. X sold his stake to Indian promoters in February 23. So there is a transfer of shares of Indian company by a foreign national to Indian promoters. So if you know, there is a filing which is needed, that is from FCTRS, when there is a transfer of shares between resident and non-resident for an Indian company. There were also ESOPs which were issued by Indian company to foreign employees in year FY 22-23. It has been proposed to increase the corporate guarantee from $3 million to $5 million. So there is also another overseas transactions made by Indian company to corporate guarantee through Singapore Limited, PPT Limited. company invested another 10 lakh rupees in a new company, B Private Limited in India, which was set up as a Indian company in July 22. So whether there is a downstream investment which one is to be reporting. Mr. D, proprietor of D and Associates, a participant of Sky High Symposium-86, is appointed as an auditor for 5 years and has been asked to look into the past compliances and let the company know if there are any lapses and contradictions. Let me tell you, this is a very, very, very uh, common assignment which you could get when you are into pharma practice, where you are asked to do a daily diligence, or as a part of your audit uh, exercise, you are asked to check upon this in the year where you are auditing. And sometimes they would also ask you if there is any, management requires any uh, deep dive in the transactions which are undertaken in the past. Just a second. I hope facts are very clear. We will again and again look upon it and see if there are any, anything we need to go back to while going through the questions and queries raised by Mr. D. So, the first question, which I think would be in almost in everyone's mind when I went through that, facts, whether any approval under FERA was once copy provided, kindly study the same. If the company says they have obtained the FERA approval, you check that copy, make sure whether it is really many times they always what I have seen is that they have asked that we have permitted this on the basis of so and so documents. Once that documents is permitted, submitted, you get a number which is known as unique number, a registration number, which is being given to each and every foreign investment in India, uh, and that needs to be kind of referred to whenever there is any filings which are being taking place as far as RBI is concerned for that foreign investment. Whether any necessary filings like FCGP were made. As we saw, the company had also issued a shares under right issue in 2004. Whether any approval was obtained by RBI for transfer of shares. So here is a twist. We had come across this one of the listed companies. They had obtained approval from the RBI or central government in the FERA time, and the approval told approval, mentioned that if these shares are ever transferred, you need to take a plan. However, since the shares are transferred after year 2000, FERA doesn't apply. Hence, you have to follow the law which is right now in place. Under current law, even after 2000 and even today, the only compliance which is there is filing of FCTRS when there are transfer of shares. In this case, there was a transfer from a non-resident to non-resident. Such transactions doesn't involve any approval, neither any filings, except an intimation to the company. So they record the transfer and the share transfer from one person to another person. You all must be aware in year 2018, RBI shifted the physical filing, the manual filing of all the forms to online filing with the portal access to the clients. In fact, it happened in 2016 through EB's portal. After that, a new portal which was made into which was launched, a platform called Firms Portal, and every company which had any foreign investment in the past, or was which had any foreign investment in the past, was asked to file a form called EMF. So this is another important compliance practice which one should be aware of, and that form was supposed to be filed within a window of 15 days, which was extended to 1 month. Why that was very important? Because RBI wanted a full-fledged database of all the FDI which has been taken place. Because of manual filings in the past, it has been, and even I have faced many times. The filings were done with the bank, the ED bank, but it was never reported to us. And I had many of my clients who said, we have never received any registration number or any unique number for the foreign investment which was obtained in the company. So if you see this EMF form, it is very well, in that sense created, wherein you give all the details of the past. And what is SMF? SMF is a single master form which takes into account now almost every forms, whether it is FCGPR, FCTRS, ESOP, downstream investment, any there's, if I correctly remember, there are 9 forms which can be filed on this portal. And if so, let's assume today if someone wants to do a, let's I there is a company which is to be formed by as a subsidiary of a foreign company. How should this reporting take place? So first, a EMF registration will be obtained. After this, there would be a FCGPR which will be filed. Even if there is a company which is a domestic company, 100% owned by residents, and if that is getting taken over by a foreign company, there has to be a EMF form filing which will first take place, and then there will be a FCTIS form which will be filed. So very important compliance practice which one can undertake when you are practicing FEMA for all the transactions where you get for that matter the money in terms of investment, or even for that matter transfer of shares from resident to non-resident or non-resident to resident. uh, you know uh, 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 you need filings of FCGPR and FCTRS with us. FCTRS, so for FCGPR, the filing needs to be done within 30 days from the date of allotment of shares. FCTRS needs to be filed within 60 days from the date of remittance. As we saw, if you see this, Mr. X has sold his stake to Indian promoters in Feb 23. So there is a very likelihood there should be a form FCTRS which needs to be filed. So whether that was filed needs to be asked. Also, share transfer on record cannot be taken before FCTR is filed. This is a very common contravention if the company is not aware about the FEMA filings. I hope I'm going at a perfect speed. Any feedback from the participants? Can anyone tell me, because I'm not able to see participants, or for that matter the any interaction which is going on. Anyone? Ishita, Malvika, tax support. Anyone, can anyone answer that? Okay. Hello. Everything is fine. And no questions as of now? Okay, no questions. Okay. Good. I would be more than happy to have any questions from the participants, if any. Okay. Just okay. Yeah. Loans. So, can an Indian company take a plain vanilla? So the next question is, which one would ask would be, can an Indian company take a plain vanilla short-term loan from foreign national shareholder and director under FEMA 3R? Uh, whether that is permissible? I would say clear cut no. There is no regulation which allows a resident to obtain a resident company to obtain the loan from a plain vanilla loan from a foreign national under FEMA 3R. Whether any form ECB was filed or LRN was obtained for the working capital loan. So in this case, so let me go back to our facts. If you see here, if you see this There was a loan obtained in April 22, a short-term loan from Mr. X, and it was returned in September 22 with 9% interest. So, under ECB regulations, you can only obtain loan if you fulfill the terms and conditions, and those terms and conditions are the I would say with respect to all-in cost savings, or with respect to when you have to pay a very very uh, there is a regulated number of years for which you have to obtain minimum average maturity is what we say. So there is minimum average maturity of 1 year for manufacturing companies. There is no way a Indian company can obtain a 6 months loan or 9 months loan, and that too form of foreign national, and pay a 9% interest. Even today, if I see, yeah, you can pay 9% because the rates have gone higher. But if you see the it goes as LIBOR was replaced recently by SOFR and other benchmark rates. So the average all-in cost ceiling, which one should be adhering upon, would be a benchmark rate for plus 550 basis points. So one has to see whether that loan rate falls into place. Secondly, whether average minimum average maturity is compliant with. Since in this case it was just a short-term loan, the loan taken by the company is pure contravention and is not allowed under FAM. Whether Form ECB was filed, uh, 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 and LLM was obtained for the working capital loan. If we see, there was a working capital loan which has been obtained by the company from Bank of Tokyo, whether minimum average maturity or all-in cost ceiling for the same has been complied with. Also check whether the end use of loan is obtained. So when you obtain loan under ECB regulations, you have to mention the end use. So if you obtain it for some capital expenditure or for specific expenditure, it has to be used. There is a CS or the CA who has to certify every month in Form ECB2 whether the end use has been complied with, what was the opening balance of the loan outstanding, what was the repayment, drawdown, and the closing balance. So this is very, very important, whether you have to check whether all ECB2 forms have been filed on the monthly basis. Each delay will cost a very heavy late submission fees. It can run up to 50,000 per month. Of course, there has been liberalization recently where the fees has been reduced. But let me tell you, I have seen where the companies have obtained ECB. Uh, Many times they file all the ECB2 forms 6 months together, and there is a heavy late submission fees that needs to be paid. Now, what happens if you don't pay late submission fee, or you delay in paying those? You're not allowed to enter into any foreign exchange transaction. So let's assume you have taken ECB, you're not filed your form ECB2 forms, and you want to do a ODI. You will not be allowed to do ODI. For that matter, if you don't file your annual return on financial and liabilities, then also you are not allowed to do ODI. Or for that any for matter any other foreign. This is the stringent compliance and implementation of law which has been taking place very very recently by the banks, and hence it is very very important to comply with all the filings. We saw there are import creditors. We need to see the aging of the creditors which are outstanding. We need to see whether they were outstanding by more than 6 months, because currently up to 6 months it is under you can pay within 6 months. More than about that, if you want to delay the payments of imports up to 3 years, you can do, but with the prior approval of the banker. If you don't do, then there would be a deemed ECB which would be taken. It would be said as a deemed ECB. Whether there are any writes off which has been as far as import creditors are concerned, was there any self write off which has been done? Write offs are being very very stringently been regulated by RBI. Let me tell you, you cannot just write off any imports. In fact, there are also compounding orders where there was a write-off of an advance. I'm talking about exports. There was an export which was to be done, and there was an advance which was received by the Indian company. Unfortunately, the foreign company was closed. So they were not able to return the advance. You won't believe RBI penalized the company. Why did you not export or return the advance? The impossibility of performance was not, entertained, and hence it is very very important you comply, you do due diligence when you are doing imports and exports. Documentation is very robust. If there is anything which is outside your control, please document. In face of import creditors being written off, you need to see why would you not pay to that person. You might say, okay, this is a positive thing for the exchequer because you're not paying, so your foreign exchange has been saved. But no, it doesn't work like that. And you need to be, there is also no self write-off which is to be done. Most write-off also need a certificate from CA. For fixed assets, when you purchase any fixed asset, you have to see whether any loan was purchased for the purchase of machinery. We saw there was a machinery which was purchased. So whether any loan was purchased, whether the ECB which was taken, most of the infrastructure companies which I have dealt with, they obtain ECB for import of machinery. So let's assume you import a tunnel boring machine, right? So most of the companies would do a tunnel boring machines are heavily imported from outside India. They have tie-ups. So the companies who are exporting tunnel boring machines to India, they have ties with large financial institutions to refinance that, to finance that, and that's offer a very very reasonable rate of interest to Indian buyers. And I have seen one needs to be checking whether any loan been obtained and whether the end use restriction on that loan has been complied with. Now let's come to the investments. Investments in terms of outside India investments. Okay. So whether from FC, let me just give me a second, a minute, please. Yeah, sorry. So the point is, what I was saying is now we are going to look up to overseas investments. Okay. Whether Form FC was filed. Now, these forms have been changed, as I told you. There has been an overhaul of ODI regulation. And that's why this has now become one of the emerging practice in FEMA. Indian MNCs, Indian companies have been now going outside India, forming joint ventures, forming subsidiaries. It is not only that India is now receiving foreign exchange. Indian MNCs are now also investing outside India. We are buying companies outside India, and there are a lot of compliances in per se for that thing. Earlier, it was known as Form ODI. Now it has been replaced by Form FC, which needs to be filed at the time of investment. In this case, we saw there were two subsidiaries, one Singapore and another Australia. Australia was also closed in the current year. It was opened in January 22, it closed in December 22. So one is to understand whether Form FC is being filed at the time of opening of this. When you disinvest, you have to file Form FC Part G. However, one is to be very much careful under new and even old OI regulations. You could not disinvest or you could not close your foreign subsidiary before completing 1 year of operations. In this case, the company had closed down the company within 1 year. It opened in January, it closed down in December. So it didn't do 1 year of operation, hence it's a contravention. So this needs to be informed to the company. After you invest, after you do file from FC, you make all the remittances, you get a UN number from the RBI directly. Once you right now the overseas compliance is through the AD Bank. There is no portal like it is there in FDI. Uh, and you have to also obtain the proof of investment which you have made and give it to the bank, whether it is share certificates or whether it is partnership agreement, or anything else. Also, APRs are to be filed every year. APRs are known as annual performance reports. Annual performance reports are to be filed every year, and we need to check since the Australian company was closed within a year, so there won't be any APR which was supposed to be filed. But even for that part of the year, it was a contravention. We need to check. We need to ask the company whether they have been filing APRs every year for Singapore company. Now, a recent let me tell you the API due date is 31st December. So we, as our office, and even people who are into pharma, we are very much tied up with the API filings. This is the last 3 days for them. And let me tell you, API filings are to be done every year on the base of audited financials. This has been made mandatory from last year. Unfortunately, most of the countries where outside India, audits are not compulsory for each and every entity. So in such case, what happens? Can you do audit from? Can you do it from an Indian charter accountant? Yes, that is what has been allowed by the authorities, by the AD bankers. Now the next question comes. There are many. There would be many participants who must be experts in audits, but I am told and I've been advised I've been advising that if it is to be done by Indian charter accountant, he has to do as a special audit assignment, because under statutory there is no statutory law which asks Indian charter accountant to do a audit of foreign company. Plus, when you are doing this only for APR, this is a limited audit, a special purpose audit which you are doing. So this should not be taken as an audit which is answerable under the statutory law of that country. So you might not be allowed, or you might not even be aware of how to comply with the laws of that country. So the audit which you will do, keep in mind the standards and everything issued by Indian regulators. The next question which will come after looking at the balance sheet will be whether any downstream investment was made. In this case, if you see, we have been told in the case study facts that there was a downstream investment which was made by company in a company called B Private Limited for opening a manufacturing company, a new manufacturing unit. However, a downstream investment for a downstream investment, you need minimum of 50% holding by a foreign investment in the first level company. The first level company, which is A Limited, just has 20% shareholding. That 20% shareholding, then there was a right issue and then there was a bonus issue, assuming that it was only done for the part of it. Whether there is, if it was more than 50%, there was a form BI which was supposed to be filed at the time of down industry investment. So this needs to be checked. Another thing is we came across with respect to corporate guarantee. Now, when there is a corporate guarantee also forms part of the foreign overseas investment. You would say that, sir, there is no remittance, or there is no remittance to be done. No, there is no remittance, but there is a liability which has been created by the Indian company. And under FEMA overseas investment rules, all investments made should be under within 400% of the net worth. This is a limit. As far as individuals are concerned, this is $250,000. However, the corporate guarantee can only be given by the entity. It cannot be given by individual for his individual investment. Yes, a personal guarantee forms part of the 400% net worth when you're giving on behalf of the company. That needs to be checked. Every renewal of the limit or guarantee of new form FC needs to be filed. Can Form FC, can a short-term loan should be given to outside India? Yes, there is no restriction on giving short-term. However, Form FC has to be filed for the same. And yes, that has to be within 400%. And if I'm an auditor, if I'm not aware about past and I just want to see whether it is being complied with, I want to just do a bird's eye view of all the transaction and whether that is complied with RBI, what should I do? I should ask one simple report from the bank of the client. Project profile report. It is called as DPP, detailed project profile. It gives you a status of the UIN and gives you a status of each and every filing made by the company and reported to RBI. Many times it so happens that you do the filing to the bank since this is still in the physical form, but bank doesn't do that filing in ODI portal with RBI, and hence there is no line item which you will see in the project profile. As far as Australian subsidiary is concerned, you will ask whether it was lasting for 1 year, as I told you, since it didn't last, whether if you are doing this investment before 1 year, you have to ask for the RBI approval, whether that was obtained, whether all compliance up to the date of investment from Australian subsidiary was complete, whether Form FC per Section B G was filed at the time of liquidation for Australian subsidiary. All these are the important points which needs to be kept in. Now we go to the uh, current assets. Okay, in current assets, a very obvious reason would be to ask whether the receivables include any export debtors. If you do exports, very likely you might be having any export debtors. There is a aging which needs to be obtained, whether if it was outstanding for more than 9 months, whether any approval was obtained. During COVID, it was extended, but after COVID, it was not extended. And if anything, beyond 3 years, you can always obtain approval of keeping it outstanding beyond 9 months for banker. There are limits for the same. And if you go beyond 3 years, it becomes a deemed loan and it becomes a contravention. If you write off an export debtors, there is a detailed documentation which is being asked by the bank. Self write-off is allowed up to 5% and 10% with the help of the AD bank or the permission of the AD bank. However, certificate from CA and the detailed, robust documentary evidence needs to be submitted. This is as far as export is concerned. Now, as far as coming to the branch establishment outside India, whether the branch setup outside India is in line with the opening of foreign account regulations, 10R notification regulation 5 allows you to open a foreign account for the overseas branch. There is a limit on expenses which needs to be done. In the year when you open a foreign branch, 50, 15% of your export revenue you can do as a expenses and 10% after that. So this needs to be kept in mind when you are opening up a branch and expenses towards the same. FLA, a very, very common return for all the FDI and ODI transactions. If a company has a FDI, if a company has a ODI, it needs to file this. And there is a separate portal for this from 2019. Before that, used to send a Excel-based form on a ID, which was be done. Now it is a Flare portal, like Forms portal is a Flare portal. You need to file this every year before 15th of July. You can file on unaudited financials. However, if there is a change in audited financials, you have to revise this form. Uh, we were also told by the company that they have issued ESOPs. So when we have issued this ESOP, whether any ESOP form was filed, because when you issue any ESOPs to a foreign person, the form ESOP needs to be filed within 30 days from the date of issue of this ESOPs. The purpose code and the purpose mentioned in the Form 82 for the role of a foreign exchange, if the foreign exchange is used for any purpose which is not permissible or does not being used for any purpose. As I told you, when you remit money outside India, you have to you have to fill up forms. One of those forms is Form A2 under Section 10(6) of the FEMA. If you say that I'm going to remit this for investment, and instead of investment you use for XYZ purpose, it's a contravention. If as an individual, if you remit this, let's assume you remit this for education fees, and then you use it for gifting to someone, it can be a contravention. So a scrutiny of all outward remittances and A2 forms is to be done as an auditor. And this is where I think this section becomes very important. What I have done is I have given a detailed checklist for due diligence, both for FDI, both for ODI, and you can just go to is this can be yours ready right now. Okay. And you can always refer to this when you are doing any audit, and make sure that you see whether all the forms have been filed. I think this one case study takes into account most of the things, whether it is FDI, ECB, branch, ODI, exports, imports. Uh, so yeah, I think this is what I wanted to give you a flavor that where as a professional, if you are doing a FEMA practice, how and where you can come handy. Now there is another case study which I have taken from ECB perspective. Now, what if a company in India, let's say AS Limited, a triple A rated company, is an entity eligible to receive FDI, has obtained ECB from three banks in 21. Uh, Due to difficult market conditions, the lender wanted to restructure these loan agreements. Bank of America, which has given $4.8 million, is converts its borrowing into equity. Subsequently, Citibank secured its loan against investment in shares, partly against international corporate guarantee. Due to discontinuance of LIBOR, uh, 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 it wants to do it at SOFR plus 2.5%. Deutsche Bank restructured the loan agreements by whereby the new terms are as follows: $15 million at SOFR plus 4%. And there was a delay in getting permissions. Age limited use utilize the funds into investment in domestic securities, that is equity market. King Funds Limited provides center payroll services to Ace Limited, and thus there were import payments outstanding of USD 1 million for more than 4.5 years. Now, Mr. A or Mrs. B is been asked to do a due diligence of this Ace Limited. So we have given some questions. I don't know, whether it can be interactive. Otherwise, I would have asked this question. Is Ace Limited an eligible borrower under ECB regulations? The answer would be yes. It's an eligible borrower. Every Indian companies can obtain. Whether Ace Limited can convert his borrowing into equity? Absolutely yes. You have to file form FCGPR, and if because see, there is a logic behind why you are allowed to convert into equity. Equity is always a long-term investment. You must have definitely heard about hot money, uh, where we always say, okay, there is a lot of FI coming, it's so hot money when the market is boom and then market falls, it takes it out. But those are all are tradable secondary market. However, if there is an FDI, which is a primary market, it is always told as a long-term investment, and it is known as FDI. In case of FDI, government is very, very encouraging people to invest. If a eligible borrower converts his borrowings into equity, there are mechanism under automatic route. You have to do filing of FCGPR and you can definitely convert your borrowings into equity. Is a body corporate allowed to create charges on his assets? Yes, there are different conditions for the same. Any lender would definitely need some assets collateral to give loans. So yes, under ECB regulation, you can definitely create a charge on the assets. In fact, there is also regulation wherein if tomorrow there is a default which happens, how that charges can be invoked and the money can be remitted outside. Our invest interest rates in case of all ECBs in under all-in cost ceiling. See, if you see, largely uh, it is all are at LIBOR plus 2.5, 4.25, 3.75. Now LIBOR has been replaced by SOF. Even after that, if you see, it is below that 550 basis points which I said, and even 500 also. There are two rates, 500 basis points. So this is much below that. So I think yes, the answer would be yes to that. I would have asked this question from the audience, but since there is no interaction, I would have been loved to have those answers. Uh, Whether the parking of EC, so if someone from the tech support or Ishita or Malvika can say, I would like to get this answer from the participants. If you have any response, let me know. I'm asking a question whether ECB proceeds can be invested in domestic equity market. Answer yes or no. What is the general understanding of the participants? I'll wait for 10, 15 seconds or 30 seconds. If there is any answer, you can tell me and then I can give you my answer. Do you feel that the money obtained for loan for certain project, and if you are not able to use, can you invest that in the equity market? What is your understanding of FEMA or even general understanding? Yes or no? It might be 3 months, 6 months, 1 year. Any answer from the participants? Have you received any answer, Mr. Manshuk, Malvika, Ishita? No answers? Okay. So the answer is no. You cannot invest in equity. In fact, there is a provision where you can park your money in fixed deposits. Now, in this case, it was clearly said that they have invested in equity market, which is not, permissible. So yes, so this is something I think which you need to be aware of, that it is not permissible to invest in the equity, even for a day. Where, there is no borrowing money cannot be used for capital markets. Utilization of not allowed. Where can the ECB agreement between ACE Limited and Deutsche Bank be refinanced, restructured? Yes. Will the change in this due to diesel lead to revise? No, it doesn't happen revise, but yes, it gets updated. In fact, new ECB has to be then obtained as far as the new regime, the new rates are concerned. Will the amount outstanding against import payables is governed by ECB? Yes, it will be governed by import of goods and services, not by ECB. However, as I told you, if it goes over the 3 years, it becomes deemed ECB and hence it gets covered by ECB regulations. So answer is yes. And there is a huge penalties which are levied under compounding orders where imports have been outstanding for more than 3 years under deemed ECB regulations. And one is to be very, very careful about that. I've also given a fact checker a list of factors which one is to consider while undertaking the due diligence under FEMA as far as ECBs are concerned. Whether the terms of the loan exceed all-in cost links, ECB2 form was filed by within 7th or day. The due date for filing ECB2 form is 7th of the next month for which it is applicable. Whether form FCGP or ECB2 was filed when we were doing the conversion from ECB to loan to equity. Uh, Now the third and the last case study which we are going to deal is imports and exports. Here I will show you that where you can come handy when you are going for audit or you are given BIRD by assignment by the client that please look into our imports and exports from FMR perspective. The major work which a charter accountant has to do is check the aging of imports, aging of exports, write-offs if any, and if they have converted those into any equity. I have come across where there was a export receivable by Indian company, and the overseas company said that we don't have any cash flow to give you, but we can give you 10% of the shares of our company. Yes, that is allowed. You have to file Form FC. You have to comply with all the ODI rules and regulations. But all this needs to be taken care of. So the first question is here when we see the facts, Tea Limited, it imports coffee from Ghana and Africa. The terms are 30 days, 90 days. For exports, it is 30, 60, 120 days. And sometimes, it also comes within 250 days. Due to litigation with certain parties, the payments and receipts are outstanding for a period of first year and second year respectively. It also has received a advance from an agency. It also paid an advance from an agency for imports of $1 million. Other terms of imports and exports, yes, they are in guidelines. We saw for imports, you can always pay within 6 months. For export, you can pay receive within 9 months. So right now, what we see is 90 days for imports and 30, 60, and 120, even 2 to 50 days, which is less than 9 months. So yes, they are under this. Can you pay advance for imports? Yes. However, it has to be squared off within 6 months. Even exports needs to be squared off within 12 months. Whether there is any extension which is allowed beyond the term, yes, you are allowed that extension, but with the approval of AD banks up to 3 years and then RBI. Litigation request, yes, very much accepted, but you need a robust documentation for the same. Uh, uh, im- Services, now this is where the problem comes. Uh, how the services are being regulated? Yes, because services doesn't have any per se, uh, I would say, expose you have bill of entry, bill of lading. Services, how would you show that you have uh, given an advance and it has been combined only by your books of accounts? Only by the, if you are a software company or if you are ITS company, there are something called SOWs, MOU, and the billings which takes place. So that are the view takes where there are very large imports and exports of services are taken place. Banks do track those. Otherwise, they are not very. There is no like for exports and imports. There is two system called IDPMS and EDPMS, where you have to match each export payments and invoices, and you have to also match the receipts and the invoices which have been raised by. These are some of the concept checkers which have been given, which you can always take care. Now, the last slide, opportunities for CA in FEMA. I would, these are just illustrative lists. Let me tell you. You can do FDI advisory, you can do FDI reporting through Forms portal, which includes FCGPI, FCTIS, Form ESOP, Form ODL, all the 9 forms, ECB advisory, filing of Form ECB for obtaining LRN when you first obtain the loan, you file Form ECB2 monthly, Form FC filing, ODI advisory, restructuring, compliance, LRS. No, this is also, I've seen many individuals asking questions free of charge, but as a charter accountant, you should value your professional time which you give. A lot of HNIs, lot of NRIs ask lot of questions as far as LRS and remittance from India is concerned under $1 million scheme from NR and NRE, which they are allowed every year. NRIs are allowed to remit $1 million every year. So those advisory can be part of your practice. Imports and exports of goods, I already explained you. Matching with IDPMS, EDPMS is also something which clients do ask. Then write off applications, we can be handy with our legal expertise and the professional expertise in drafting those applications. FEMA audit due diligence, if you get the client like case study one, it can be a huge assignment. And the very important one is compounding. So after contraventions, there is something called compounding which needs to be done. There is a filing of compounding form in physical needs to be done with the regional office or central office, depending on the nature of contravention which has taken place. The compounding gets closed within 180 days from filing the compounding application. So that needs to be kept in mind. So yeah, this is also one of the very important practices. And whenever there is any resource, where is there any structuring or restructuring takes place, there is a tax advisor. There is always a regulatory advisor which needs to be given, and that's where you can come handy as a professional practicing in the field. Thanks a lot. I did expect a lot of questions. I'm open to that even now. But yeah, I would rest my presentation here as far as today's talk is concerned. Uh, Hello. Uh, yeah. You have any questions? Hello. You had any questions? Okay. 7th of the next month for that month. It's a monthly compliance. So for April, the due date is 7th May. For May, the due date is 7th June. Whether approval is required for writing of foreign data? Yes, if it crosses 5% or 10% respectively. Up to 5% is self write-off. Up to 10% you can go and check with RBI. Above that, yes, you will need the approval from the RBI. Yes, you can revise Form APR. Yes, it is possible. But what happens when you revise Form APR? Many times, it changes even your. So if you revise 2 years back, your next 2 years APRs will also be changed. So you have to do 3, 4 revision. But yeah, APRs can be revised if you have missed out on it. Any other question? You want to you want me to repeat on any some concept or something? You want to ask me that what is as a you know professional opportunity? I'm ready to answer any questions on that. Non-reporting of. Yes, yes, it is seen as a contravention, not per se that way. If you remember, in before 22, there was in fact a regulation 13 of FEMA 120, where if you don't intimate within 30 days of formation of SDS, it was a contravention. There are compounding orders for the same. Now that requirement has been clubbed with filing of APR. So today you don't have to report SDS. You have to just include that in APR. If you don't do this, you are doing incorrect filing, and you might be asked to pay penalty for the same. But there is no specific regulation now. So we need to see how the law will evolve. Which approval? Which it was related to which question? But matter, can you tell me the matter? Yes, RBI will normally don't give you approval. You have to always do your application through the bank. But can you ask the participant to tell me the matter of which approval, on which matter? FDI matter, import, export, which matter? So you are not allowed to write off any. In fact, free of cost. There is a specific regulation just before the master direction. There is a documentation requirement for that, free of cost. Otherwise, yes, you cannot just write off. You have to take the approval. With regard to ECB, there is a question. With regard to ECB, can penalty can penalty be waived or appeal? So regarding with ECB now, LSF is, yes, you can always say, you can always ask RBI to waive off. Very, very rare they have waived off. There is no appeal, by the way. There is no appeal mechanism. There is only compounding, or then you go to ED, because RBI is not an investigation entity. ED then has tribunal which operates at Delhi, and you can appeal. But I would always say that is the last. It's very rarely used. If you are levied any penalty on non-filing of ECB, if it can it be certified? It has to be, APR has to be certified by statutory order. There is no if. It has to be certified by statutory order. After it has been audited financials and APR has been prepared by the company and signed by them. Anything else? And end use of the loan, do we have to physically inspect? Yes, you have to check the bank statements and take the necessary whatever audit precautions you take, or exercise you per se. You have to check that. Yes, physically per se. Yes, if they say that it is for capital goods purchase, you need to have invoices for the same. In that sense, yes. 7,500 for non-filing of APR now. It was earlier higher. Now the penalty is 7,500 per APR for non late filing or non-filing. Any other questions? Thank you. Thank you. So Jayaji, should we wrap up, or you are waiting for any other questions? Hello.
Hello, friends. Thank you, Hardik, for this wonderful session. It was amazing section where everything you have covered for FEMA along with the opportunities for CA, and plus answered all the questions. And with so less questions, we are assuming that everyone has understood everything. And further, I think they can contact you if they have any more queries. So it was a wonderful session, and we thank you for your contribution.
Thanks. Thanks a lot. Thanks for giving me the opportunity. Thank you.
Welcome.